And good afternoon, everyone. John Hutchinson with Traders Reserve's Options Income Blueprint. We have a fantastic presentation for you today, and my special guest, as always, is Michael Schulman. I'll be introducing him in just a moment. But before we get underway, we do have a few little notes to take care of right at the start. First and foremost, this is a live presentation. This is not a recording. It will, however, be recorded so that if you miss any part of it, or if you have to leave early to run off and watch some of those NCAA basketball games, you'll be able to go back and watch this presentation in its entirety once we have concluded. So we'll get a link out to you folks after the fact. So the second thing is we want to make sure that the audio and video is coming clearly through to you. So if you would take a moment, please, and type a yes or a Y in the chat box to the right of your screen, and let us know that you can hear us okay, or at least hear me. And also feel free to let us know where you're from. We always like to know how far around the globe our presentations are reaching. This program does tap into Google Hangouts, so there is typically an audio delay of about 30 to 45 seconds from the time that we start talking to the time that you start hearing us. So do be aware of that. We will try to avoid any awkward pauses and silences, however. And then last and not least of all, because this does use Google Hangouts for any reason, if you have a technical problem, such as if you can't hear us, if your screen freezes, best bet is to simply log out and log right back in. Because we use Google Hangouts, obviously it's their technology, not ours, and we don't have any control over the technical functions. So Michael has a very phenomenal presentation for you today, all centered around the Federal Reserve's announcement on Wednesday. So I'm going to turn this over to him in just a moment. Again, if you don't know Michael, he's a 30-year veteran of the stock markets as a trader, as an analyst, as a financial writer. He is currently the expert, if you will, for income investors behind the Options Income Blueprint. He'll talk to you a little bit about that later in this presentation. He's also a published author. His two books, Sell Short and Made in America, can be found on Amazon.com. And as we get underway, we do have to make the lawyers happy, so just bear with me for a quick moment here. This is a U.S. government-required disclaimer. Forex, futures, stock, and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. And no representation or implication is being made that anything that we tell you in this webinar is going to make you money, even though we believe it will. So there you go. If you enjoy watching paint dry, grass grow, or water boil, you are welcome to watch our entire or read our entire disclaimer at tradersreserve.com or at optionsincomeblueprint.com. And we've got some great folks here already from North Carolina, Los Angeles, northern Minnesota, Arlington, Virginia. Michael, that's right in your backyard. New York and Belgium. Awesome. Well, we went international there. Texas. Sorry about your Longhorns yesterday, Richard. Atlanta, Georgia. Go Georgia State. A couple of people from Georgia. Congratulations on your teams. Maryland, Stephen, San Diego. Florida, awesome, excellent. Some great folks. Nampa, Idaho. California, excellent. Looking fabulous. Chris in New Mexico. We have some folks who work with us out in New Mexico in Albuquerque, Chris. So welcome, sir. All right, so Michael, Federal Reserve, take it away.
Thank you, everybody. And the only team worth watching is the Georgetown Hoyas, and you know by now where I went to college. We wanted to get this in front of you very quickly because there's always a lot of confusion about the Fed, which is both unwarranted and fed, and my wife is a journalist, and fed by the media and all the people with the blow-dried hair who are looking for free coffee before they go on the air and saying this, that, and the other thing about the Federal Reserve. And what I'm really talking about is traders trading an event, worried about this, worrying about that. In the real world, a quarter of a point doesn't really mean anything. It would put some people out of the mortgage market and so forth and so on. And the debate in the Fed is if they raise a quarter point, it means they like the economy. If they don't, what does that mean? The announcement on, and after this, we're going to get into some really tremendous looks at stock picking in the light of the Federal Reserve and what to do. But just to go over this chart very slowly, interest rates aren't going up, and the two things that the Fed wants to see is inflation. We don't have any. And they want to see wages going up. They don't see any. It's meaningless. And if you look at U6, which is the real unemployment rate, it's people who are working part-time that don't want to be, it's still in double digits. I've been on record for a long time that rates will not go up this year. So I won a series of nickel bets, gentlemen's bets with people this week. Now the bond market, through the bond futures market, is essentially saying they think rates will go up around October. Not going to happen, but that's not important. What's happened is what happened this week. What happened this week has generated tremendous opportunity for us in that the Fed is now in the rearview mirror for at least 2 quarters. It's very, very, very important that you accept that, because as a long-term investor, you shouldn't care. But long-term investors can trade for income. You can make that hybrid approach. You can be an investor who trades for income, and you can be a stock picker. And now, for the next 6 months, you don't have to worry about something untoward coming out of Fed headquarters. It's very, very, very important. And just to wrap up, the other reason that the 2 reasons not spoken of is the Fed won't raise rates because of the dollar, and they don't want the dollar to go higher because that will impact employment because of exports. The reason they might is they just may be uncomfortable after 7 years of 0% interest rates. Both are valid arguments, but we don't really care anymore. We're looking at the next 6 months and what we can do. It's time for us to trade for income, but not in a way that you might think. When I typed 3-month CD rates into Google this morning at bankrate.com, this is what we came up with. This was as of 8 o'clock this morning. You can see. That's what you would get for what is considered to be a risk-free investment over the course of 1 year. That's a 0.6% rate for a year. That's the highest one, or 4 or 5. Now, when you look at these rates and you think the Fed's not going to raise rate, what comes to mind? You're struggling to get consistent income. Even if you're doing well, it's the consistency that's important. You may even be angry because you're old enough to have experienced meaningful yields on bonds and meaningful yields on dividends, and it's not happening. Dividend stocks are in a funk. You may be frustrated by losing money trading options or blocks of shares. And what you really want is a simple, straightforward way to put cash into your account. Cash to pull out of your account to live, to have fun, or cash to reinvest. And you still are hoping for annual returns of 15 or 20% or more, which is reasonable for any well-managed individual account. In the next 30 minutes, I'm going to try to give you a proven strategy that it's going to deliver the 0.5% you saw in the CDs. But it's every week. It's not every year. It's every week, or it's 2% or more a month. It's 6% or more a quarter, or it's up to 25% a year, maybe more. It's all proven. This is statistic. This is facts. This is not my hope and not my dream and something out of a textbook. I developed a really simple low-risk trading strategy that if you're retired, restore retirement security and comfort because of the consistency of gains. To put hundreds, maybe thousands of dollars in cash in your pocket every single week or month or quarter or year, depending upon how you measure yourself and measure your gains, and end the income frustration that many of us felt, including me, which is how this all started. And it takes 30 minutes a week. Based on surveys of the average allocation that people put to my program, they're averaging over $250 a week in total income, more than $1,000 a month. And in the last 4 weeks, we closed trades with the following returns. You can read them, but I'm going to read them out. 0.94, 0. And forgive if there's background noise. It's snowing in Washington. I'm not in the office. I know how to drive in the snow. Nobody else does. So that's not a member calling for advice. That's just I'm working out of my home.
Michael, can I pause you for 1 second?
Sure.
Check the Webinar Jam screen.
Yeah.
And there should be a green bar at the top, and make sure that the present to everyone is checked.
Green bar. There's no present to everyone. Why are people not seeing this?
A couple of people, but I just want to make sure that if it shows that you are sharing your screen, it should say present to everyone.
You are screen sharing, yes.
Okay, then we should be good. Again, folks, if anyone's having a problem, best bet is to try to log out and log back in. If that doesn't solve the problem, there will be a replay, and we will have the replay out to you within an hour after we finish. We should be finished a little before 1 o'clock this afternoon, and we apologize for any inconvenience. Michael?
Sure. These are the last trades closed in the last 4 weeks: 0.94, 0.89, 3.47, 1.4, 0.8, 1.2, 1.0, 0.5, 1.09. I'll read them quickly because you can read, but you notice the market has not exactly been easy the last few weeks. And how many of these trades lost money, and the cash return based on a simplistic analysis that we do based on a simplistic view of how an average member in my service would perform would be at least $350 a week. These weren't garbage names. I'm not speculating, and you should never speculate when you're looking for income. These were the companies that were traded. And these were not the only trades. This is not selective editing. These were the only trades that were closed out. This is not I pulled out some numbers. This is just what can be done when you're shooting for bunt singles and singles or layups rather than trying to hit a three-pointer or hit a home run in baseball. And all these numbers would combine on an average size account based on our survey responses of people allocating money to this tactic of over $18,000 a year. Now, I bet you're missing out on it, and I think it's time to change that, so I'm going to go over specifics in a moment of how you can even get started right now. First, John already introduced me. I am a 30-year veteran of trading stocks, not necessarily in markets, as a professional trader on the floor in my own account. I've written 2 books. Please buy them on Amazon.com. I write frequent articles for Seeking Alpha, Microsoft Money, Traders Reserve, occasionally Investor Place. And I've worked with thousands of people both in the Options Income Blueprint service, and I have 2 advanced coaching services where we do live webinars several times a week where we both coach and trade together. And most importantly, since 2010, I've been working with individual investors just like you on selling options, and this is where we start learning right here. The introduction's over. This is a strategy of selling options, not buying them. Selling them, not buying them. See, 4 years ago, and it's actually more than 4, I have twin sons, and they were both about to go off to college. It's not cheap. They were going to those beautiful and actually well worth the money liberal arts colleges. And I discovered the hard way I had to deplete too much of my retirement account. It was going to take too much of a dent and make it up later, or create a simple, repeatable system to put cash in the account on a regular basis because I had to extract it from a regular basis to pay tuition. I've been doing similar things for a long time to hedge my portfolio, but my target was 0.5 to 1% a week, 2 to 3% a month. Every week, every month, mark it up, mark it down. I couldn't worry about that. I had to worry about making tuition payments. And it worked. And at first glance, you might think, if you're an experienced options trader, or if you've occasionally dabbled in options, you might think 0.5 of 1% a week is really not that good. But a $50,000 portfolio, doing that is over $1,000 a month, or $13,000 to $26,000 in annual income. It's a lot of money. It's really something you need to consider. The whole notion of selling options and doing it week by week, month by month on a consistent basis. So you have a $100,000 portfolio, and I'm not suggesting you can get these returns. We usually shoot for half of that. But theoretically, based on trade results of the most aggressive people who keep in touch with me by email, that's what some of them might do in an outsized year. Typically, when we're doing transactions, we're hoping to do 0.5% a week on a consistent basis. And even if you have a small portfolio, this works. A little less flexibility, but it works. So please stick with me because I want to get you ready to do it now. Independent of what happens when this concludes, you should learn at least a few things so you can get started taking a look at this approach to the market. But before I do that, in case you're looking at does this really work, we've been doing this since 2010, and these are the wins. This is just data. There's no spurious editing or whatever you want to call it. It's just when you're going for those bunt singles, you're going for a single, you're going for a pass behind the line of scrimmage. This is the kind of record you can rack up when you're not speculating, you're not block trading and hoping to trade an event. This is what you can do. And here's a quote someone sent me unsolicited. Your service is well worth the money. It's hard to believe how good these tactics are. I started with 200,000. It's now 300,000. John and I and some other people were down in Florida meeting with my coaching members a few weeks ago with live seminars, and they had story after story because they've done this on a consistent basis. And now one of my members has grown his portfolio by $100,000. It would frequently touch my email. He's just sticking with it. How did he do it? By selling options. By selling. Now, before you want to say, no, I've lost money with options, let's get to the heart of learning about this. Most people who buy options, of course they lose money, 80% of the time. Actually, it's probably closer to 85%. But think about this for a second. If the options buyer is losing the money, who is making the money? Who's making it? The options seller is making the money, and a lot of it too. Most options traders, even weekly options traders, they do it the wrong way. They're trying to hit a home run trade. That's 100% or 300% or 800% winner. How do they think they'll get that home run trade? They'll buy an option. But here's what the option buyer is really buying. They're buying the right to spend capital in the hopes of getting a profit. They're buying risk at the risk and expense of reward. They're buying insanely ferocious time decay, which I'll explain in a moment. And best of all, they're buying options that expire worthless actually more than 80% of the time. Yes, I just said best of all, they're buying options that expire worthless 80% of the time or more. Why best? Because it means the options seller, me and you, we stand to profit at least 80% of the time or more. So the right way to trade weekly options, and I put weekly in here because there's some of the examples, but I'm talking about really any option, monthlies and weeklies, is to sell them. When you sell an option, you get instant cash. It's right in your account as soon as the transaction's done. The buyer is literally handing you money so that you are now managing profit while the buyer is left to manage risk. When you sell an option, you get the advantage of that insanely ferocious time decay. For example, monthlies expire a little bit slower, but weekly options expire at the end of every week. So in a moment, you'll see how you capitalize on that time decay. Let it work in your favor and against the options buyer. When you sell an option, you exploit the 80% of buyers who see their options expire as worthless, which means, as I said, the odds are in your favor 4 to 5 times. When it expires worthless, you, the seller, you keep 100% of the cash, and better yet, there's no commission charge when something expires. So if something expires after the close today, you're not spending a commission to buy it back. So don't swing for the fences. Let me teach you the strategy of shooting for 1% a week. You don't get 1% all the time, obviously, but you're trying for that 0.5% to 1% a week. Even if you're doing monthlies and you're closing them out a month, I like to measure by the week and the month. So I like to get people to focus on the consistency of measuring how they're doing, preferably on a week-by-week basis. Then you'll be able to start giving yourself an extra paycheck every Friday or at the end of the month or at the end of the quarter. And as I said, over the last 4 weeks, my followers with a typical allocation towards these tactics did more than $350. Now, most speculators, most option buyers, they speculate. I don't speculate. You should not speculate. You should accumulate cash and lots of it. So let's recap. You're getting instant cash. You're selling an option is just like selling anything. The buyer pays you. You're transferring risk. When you sell an option, you're transferring risk to the buyer. You're protecting your capital. You have one tactic available that the buyer does not to protect a trade from losing money. You can always move the position into another position. And you have simplified trade management. When you sell an option, you're managing money you've already made. The buyer is managing risk. So selling options for consistent income is a very viable and safe way to put cash in your pocket, even with a target of 0.5% a week, 2% a month, and so forth and so on. When you learn the strategy, there's sort of a thrill when you look down and you have that extra cash which you may reinvest or extract every week or every month or every quarter or every single year. And it's how I and my wife very successfully put our 2 sons through college. I'm proud to say they graduated this past year in 2014. They're now collecting their own paychecks. Ain't life wonderful? Now, how hard is it to do this? Here, let me show you. It just takes a few minutes. It's so easy to sell weekly or monthly options for extra cash without putting your account at risk. Some honest points to make. In order to sell a put option, you must have the capital on hand as collateral in the unlikely event you will put the shares. In order to sell a call option, you typically must have 100 shares of the stock held in the event you're called out. To be able to generate consistent returns, you really need to start with around $10,000 at a bare minimum. You can do this in an IRA, and the highest premiums and the largest amount of cash produced occur when you sell an option, not when you're using other option strategies that involve buying options. You can sell weekly. Selling weekly options is no different than monthly options except for their duration. The majority of weekly options exist for just 1 week, expiring at the end of each week. My approach is to sell these kinds of options, weekly options, during the middle of the week. They're scheduled to expire. But in the 3rd week of each month, which happens to be this week, every option, every monthly, in effect, becomes a weekly because they're expiring after the close this afternoon. Now you can sell monthly. Selling monthly options generates much larger cash up front. This extra cash gives you great flexibility when managing the position, and I more often than not buy back the option, actually increasing the rate of return on the capital. And point of fact, on Monday, ION members sold a Southwest Airlines April $45 put, expecting it to expire worthless the 3rd Friday in April. We bought it back this morning with an annualized return of 50%. We did 1% on that trade in 5 days. It's just that the way the stock was moving, it was not time to keep your money locked up. It was time to move on. And when I do monthlies, I try to do them in the middle of the cycle of when it's due to expire. The April was a little bit of a rarity because this is a pretty short month. As I said, more than 80% of all options expire worthless, which means the buyer loses all their money. And as the seller, guess what? You are keeping all of their money, and that value you have bought, that they have bought, decays every hour. Another cash benefit, as I mentioned before, is most of these expire worthless. You pay zero commission to close out the trade. You have no commissions on the back end when these expire worthless. It's a very powerful component of a cash management strategy. Bottom line, you really should be selling options every single week and month, racking up the extra cash, because as the seller you have these advantages: instant cash, lower risk. Remember, when you sell a put, it's no different than owning equities at that price, and fewer commissions. So let's get started with our tutorial. Meet your new friend, time decay. Time decay is the decline in value of an option over time, even if the stock price doesn't move. And it accelerates, you can see by the slope of the curve, as you near expiration date. There are over 400 stocks, ETFs, and indexes that carry weekly options that have this really, really dramatic time decay. And there's more than 2,000 stocks, ETFs, and indices with what I call suitable monthly options, because they're liquid enough to trade. You're not going to get locked into a position, and the difference between the bid and the ask is too high. You're looking for volatility. Here's just a sample chart from General Motors, which was a trade we closed out a couple of weeks ago. And you're looking for these ups and downs. You're looking because this creates what is known as premium, which is the amount of money you're paid for selling the option. That premium goes up as there's more volatility in the stock. Now, for those of you familiar with these things, the volatility in the market is at historic lows. I mean, radically historic lows. But there's still plenty of big quality companies that are wonderful companies and wonderful stocks with lots of volatility. You're looking for liquidity. As you can see in this, the $35, this would be General Motors. You can see over 1,600 contracts of open interest. Nothing's trading because this is after hours, but you're looking for that liquidity and the narrowness between the bid, what someone's willing to pay to buy the option, and the ask, which is what you want to sell the option for. You want to keep that as narrow as possible, and you want to see a lot of liquidity. And we have a comprehensive training program which gives you all sorts of parameters for looking at these things. This is a weekly or monthly options calendar. You should pick the days that you either prefer selling in the middle of the cycle. Some have personal preferences based on your personal schedule. Other, it's where the premium is. The farther away from expiration, the more premium you're going to get, but that also increases your exposure to events in the world and events around the company. So you have to pick your day, and it's this medium, this mix between premium and exposure to the market. And the bottom line is options give you enormous flexibility. You can sell weeklies that same week. You can sell weeklies for any week, meaning big liquid stocks like General Motors or Bank of America. Right now you can sell in April week 2, a weekly that expires 3 weeks from now. You can sell monthlies that expire in a given month. You can do monthlies that closed early, like the Southwest Airlines position that we did this morning. You can have trades that closed in a week, and have trades that closed in a month. You can have trades, if you want giant chunks of cash, that close in 3 months. It's all up to you. It's the same notion of looking for liquidity, looking for volatility, and looking for the premium that puts the cash in your pocket. So does it really work? I'm very simple and exceptionally fair question. It all begins with stock selection, not charts, okay? Not Greeks, the options traders trade Greeks, implied volatility and so forth and so on. You're looking for great companies, great stocks, and options with great premium. Those are what you're looking for. You're not working backwards from a chart. You're working forwards from the company. We are in a stock picker's market. Let's bring this back to the Fed, pre-Fed announcement and now. We've been a stock picker's market for about 2.5 years, since August of 12. And statistically, it's the most stock picking friendly market in 25 years, meaning more stocks in the S&P 1500 are moving independent of the movement of the averages on a given day or given 3-day period than at any time in 25 years. So when you get the company right and the stock right, you can even trade more aggressively to trade more profits. By that I mean, if the stock's at $40.25 and you really think it's going to go up, like a Halliburton, a great oil services company that was hammered because of prices, you can sell the $40 put and get chunks and chunks of premium because you're a great believer in the company and the stock, and you think the stock is fairly priced at 40. And of course, Halliburton's at 42 right now. So let's get back to the question, does this really work? Let me walk you through some recent trades I did for my members. Wait, a little bit of a news item. Today is Friday, and today is Friday of the third week of the month, so it's options expiration for monthlies. 3 trades will close today, all to expire worthless. Reminder alerts have already been sent out by my editor to members just to remind them about these positions in case they're in them and they got busy. 2 monthly positions and 1 weekly. And actually, one of those monthlies was a weekly where the stock had temporarily moved the wrong way, and we moved into a monthly position. And this morning, as I said, I closed out the Southwest Airlines position because it was so profitable in such a short period of time. It was to move on. So today's a really good day to be talking about all this. I mean, imagine 4 positions today, all just finalizing, wrapping up, and making money. But let's walk through a specific one, Skyworks Solutions, a provider of RF circuitry that's used in things like iPhones and tablets and whatever. This is a sample of part of an alert that went out in February, and it's just, the point is that you keep all the cash. You're collecting, if you look at the bottom line, you're getting $65 a contract. It expires worthless. You keep it. It's not really complicated. We sold this on the 4th, which would be the middle of the week. It would be a Tuesday or Wednesday. It expires worthless on Friday. Bang, $65 in your pocket. Probably about a 0.8% annualized return. Very, very simple, straightforward. That's what I'm saying. You could even start. You might not want to, but you could even consider starting to do this on your own as soon as you leave here, because this is a very straightforward and simple process. Here's the analysis. You get 65 a contract. It was in a long-term uptrend. The stock's in the high 90s now. And that's just 2 months ago. I told you, it's stock picking in great companies. For this trade, you need 8,100 in capital. In the likely event, you put the shares. If you had a tiny account, a $10,000 account, you would sell 1 weekly option before commissions. Option expires worthless 3 days later. With a higher capital, you would do, obviously, more money. And the mechanics of it was, you read the alert, you saw it was trading at 81. You put it out there. You sold the $81 put. All these here are the specifics. It expires on the 6th. Expired worthless, no commissions. That's just one trade. Now imagine having 2, 3, or 4 trades each week, which we do, and that's why I mentioned it today. We basically closed one. We'll have 3 expire today. You have a lot of choices when you look at the universe of availability of quality companies with quality stocks and quality options. You can see that this is very repeatable, and that's why I emphasize consistency. So you do this on a regular basis? Yes, obviously. In closed trades in February, this is the calendar year, February, calendar, we did these positions that were closed, and this is assumes 3 contracts per trade. We generated $1,400 in cash. And there's a typo down there on the bottom. If you had sold 3 contracts of Tesoro, you would have needed about $22,000 or $23,000 in capital. So I apologize for that. I was just looking down there. Same with Skyworks. It would have been around $20,000 or $22,000 to generate 3 contracts and so forth and so on. The rest of the thing, Corning was a $24 stock. To sell 3 contracts would have required $7,200. So you can see if you were managing a $25,000 portfolio and you only did 3 contracts and you were keeping some cash in the bank, this is the kind of return that you could have gotten. These are all our closed trades. Now let me again go back to the whole notion of stock picking. Why did I pick Whole Foods Market? Best in class by an order of magnitude. There are only 2 publicly held grocery stores that have extremely high J.D. Power ratings, and one is Publix, which is only in 5 states, Publix. And Whole Foods is national. It's only scratched the surface in what it's doing because of the way it reinvents itself. When I looked at this, the charts come last, but there was a really tremendous short-term volume support around 55.50. There are great premiums on the weekly options, so it was a simple trade. On a Wednesday, we sold a $56 put, expired a couple of days later. We made $50 a contract, and you can see the numbers. There's the absolute return, a little bit less than 1%, and you annualize it by multiplying it by 50. So I wanted to interject here and remind you it's great companies and great stocks. Another example of that is oil, meaning a lot of people completely ran from the market and did not play anything remotely related to oil, or they plunged in and got killed. We did a Tesoro buy right, meaning Tesoro is a refiner in the Midwest, Pacific Northwest, and has one refinery in Southern California that they bought a couple of years ago. They have an increasing use of high-quality North Dakota Bakken oil, which is lower in price than Gulf oil, and higher quality, shorter distance, lower transportation costs. We started following in the 50s. It's 93 today, and so this stock picking is the basis of generating consistent income on the basis that the Fed is behind us and we can be really comfortable not being disturbed by crazy market people and worrying about the Fed. It's really, you can play things, and you can play things such as oil. Stocks to consider right now, and that's not a joke, I own all of these. The last one, Grubhub, I won't be owning it as of probably tomorrow morning because I did what is known as a buy right. I was in one of my coaching services. I bought the shares, sold a $40 call, knowing I would probably be called out, but the premiums were so gigantic, I'm going to have a huge return, and I'm very happy to be called out of the position, so I probably won't be on that on Monday. But the rest of the positions I own, and all of these I may even have a put position on as well. But these are the stocks you too should be considering. You should always have a bullpen. I keep a bullpen of 25 names. Yours might be 5 to 10 to 15. And stocks that you know how they trade on a week-to-week or month-to-month basis, and companies you love, makes it easier to trade. So let's get back. I mean, 93% of the people who use this strategy and tactics, they make money. And that's the win percentage, but 93% of the people. So it's not just the trades themselves and the stock picking, it's the ease of doing this. It's so easy and so straightforward to just sell options to those suckers out there who are buying them that 93% of the people who do this make money. And as I said, 98% of the positions make money, and 93% of the people become comfortable enough so quickly that they make money with these kinds of trades. Another quote, unsolicited, thank you, Norman, who did not come to Florida. I did not meet him. I wish I had. But you know, this is not typical for your first week of doing this, but it certainly is typical if you stick with the program. Remember, this may seem small. 0.5% a week may seem very small, but 2% a month, 25% a year, you can do this or you can do better by just aiming for that consistency and aiming for those week by week and month by month wins. I have 2 more option trades I do want to talk to you and walk through before the presentation, but let me show you how you can get started immediately, like right now, selling options for income every week or every month or every quarter, it's your preference, every year with Options Income Blueprint. I've decided to offer a low-cost, no-hassle trial period because this is new to many of you. A 60-day trial is extremely valuable for investors and traders with any level of experience. It doesn't really matter what your level of experience is. In fact, some hardcore options buyers are the most difficult people I deal with on email because they're talking about Greeks and charts and whatever and all that sort of stuff, and I need to say this is a different universe and it's a much better one. The Options Income Blueprint program is a complete 5-hour module training program that teaches all the tactics and strategies, and you can go into these at will. It's between a total of 5 and 7 hours if you want to do the whole thing, but you can go in and out of it as you need. There are trade recommendations of the services, 1 to 2 weekly option recommendations each week. There's 1 or 2 monthly option recommendations each week. It's very clear, which you're going to walk through some of these in a moment. Very clear, simple follow instructions, as I showed you before, for both beginners and experienced traders. And it's everything you need to be able to sell options for income immediately to start getting those returns. So here's a headline from the one from this week on Monday. This is one, excuse me, from February. And this would be the reminder alert. So up here was what the alert headline, just the headline would be, but we don't let you hanging. So even though they were going to expire and you're supposedly taking care of your own business, we sent out an alert to remind you, hey, just in case you're in a position, don't forget it's going to expire worthless and maybe you want to do something with it. And every week I cover the market, I cover tactics, I do open positions, new stock ideas. We vary it because there's a lot going on that you need to be kept informed about because we are looking at stocks, not just some weird technical trading system that's speaking in a foreign language that you don't understand. No one's asked you to blindly follow anything. So last week was the beginning of the spring bullpen roundup. My top 15 to 25 stocks, 5 a week. We discussed them so people can trade them on their own. We're obviously not trading all of them every week. And we do trends. I do 7 to 10 dominant trends outside of the traditional boxes on Wall Street. And one of the things that I discovered reading some materials in preparation for Christmas was that there is an overlap in buying patterns between boomers and millennials, which are the 2 largest spending groups in the United States. Between the two, there's 160 million consumers. And there are consumers. There's no children here. And there is a boomer-millennial overlap that we've traded in stocks such as Skechers, which is the maker of lifestyle footwear. Managing a buy right position, meaning how do you manage a stock that you've bought the stock, you've sold the call, and you want to be called out? You know, what are the premiums that you offer? What strike price? This is all discussed on a week-by-week basis with tactics. A lot of the topics for the updates coming from emails and people asking questions. And I worry about the market like anybody else. And this was from a few weeks ago, the seesaw market due to oil prices. We made a lot of money. And this was how do you do it in general? Independent of my recommendations, how would you play a seesaw market based on the way oil prices were going? The key to get started now. Now, the Fed has put the bears back in their cave to hibernate. And wait till they don't raise rates in the fall. Then those bears are really going to be hibernating. But the point is, those are short-term bears anyway. There are no bears out there. You can always suffer a correction, but we're certainly nowhere near a bear market. But to get started, you need to try something, and you need to do it at a good price. And I'm thinking, this is a great opportunity. Stock pickers market. The Fed is behind us. But I'm not the kind of guy that wants to give you a good price. So we talked it over. We're going to come up with a great price. We want to get everybody in here, and we're going to try to get you doing this immediately. So it's $79 for a trial. $79. It's you get the whole thing for $79. There's no selectivity. And we'll put the screen up again with the URL and the 800 number. But this is the whole kit and caboodle. You're not a partial member. You're not a half member. You're going to get all the trade recommendations. You're going to get access to the website. It's not a trial member website. It's a You're Here Forever member website. So you get all the training materials. You get recordings of the previous live strategy sessions. I do a live webinar every month in the evening. It's your questions. I'll do a 2-minute market overview, but it's people asking questions about open positions, people asking questions about stocks, and if I know something of the company and the stock, I'll answer the question. Otherwise, I'll do research and email them back. There's bonus video lessons on selected topics, such as something we call rolling. Extra bonus reports, and of course, email access. I actually answer my emails. I'm very proud of that. There's no catch. This is not a 15-day tease where someone's going to bother you and ask you to pay more. The training and support materials are very, very, very valuable when you look at the training programs that people offer and what they pay for them. It's full access to our trading archive if you want to look at all the names we've traded over the last 4 years and get ideas on your own. And again, full access to me. I actually like my emails. They keep me in touch with the world. So again, this is all together in one package. You're not being limited by anything. You're a full-fledged member. The only thing it's a 60-day test drive. If it's not for you, it's not for you, but hopefully it will be for you, and you'll make enough money on your first trade to pay for it. It's $79. It's less than, unfortunately, I spend at Starbucks. And for purposes of disclosure, my sons do own shares. They started with 2 apiece. They now own 8 apiece because the amount of times it's split. And Starbucks, by the way, to show you how the world works, is one of my 25 bullpen stocks. It's one of the great companies in America. We started trading it back in the high 40s, and it's now in the 90s. So I'm going to make this a simple choice for you. You can do some of this alone, or you can do this and just do what you're doing. High dividend yield stocks that are in a bubble, low interest rate CDs that are basically yielding nothing, low yield bonds. You can do that, or you can learn a simple, safe strategy. Remember, selling a put is no different than owning shares. I've done this with thousands of we'll call them income-hungry investors, just like you. Just like me with putting my sons through school. And you can use this to put cash in your pocket every single week if that's how you want to measure yourself, or month, or quarter, and do it every single year. My people who I was with in Florida, I've known and become intimate with by email. I finally met them. For 4 years we've been together. I just got this email. It's the first time I've been in the black for 10 years. And most of it is due to your strategy and training. I've placed 14 trades selling puts, and I have 100% positive trades. This was unsolicited. This is just what happens if people have been beaten up by the market in the crash. They've lost money on options. This is a very different approach. It's take the risk out, just collect the reward. So if you're struggling to get the consistency in your income from your portfolio and afraid the low interest rate environment is going to continue, which we now know it will, then please learn this simple trading strategy with me. It's probably the best $79 trial on anything you'll ever enjoy. And you'll not only get, as I said, the specific recommendations, you will get the materials, the training, the access to me that will help you, hopefully, as a trader for the rest of your trading life. But it's up to you. And here's how to reserve your place in the limited trial offer. And if I remember, I promised you a couple of more trades that I wanted to walk through and show you a little bit more detail. This was a January position in Tesoro. You can see if I like a name, we trade it. And Tesoro's $90-something a share now, and you can see the stock price was $71.97. So the stock picking here is really at the heart of the way you're going to make money, both in the service and on your own. So I explained what Tesoro does. The alert goes out, and this is the level of detail that you'll see in the alert. It's very clear. It's very simple. It's very easy. And here is the roundup. It was trading at $72.60. We sold the $70 put. We collected the premium immediately. That's the amount of capital we had to put up. It closed with no commission. $45 weekly paycheck in the pocket, done. Simple, done. Southwest Airlines, again, this is the way to play oil. The way to play oil was to play the airlines for obvious reasons. And not only that, the boomer millennial overlap is overlapping in travel. This is the best spring bookings in 7 years. And surveys done by PricewaterhouseCoopers show that a lot of boomers and millennials are what are known as selectionist consumers, and they're not responding to previous buying habits. They're very careful in selecting what they do. This is part of my Christmas research, Christmas spending research, and its travel is a big deal. So between that demographic and that shift in spending combined with oil prices, the airlines were natural. We traded several of them. This was a Southwest Airlines trade. And again, we just did another one like this week. This is one from January. Again, this is the level of detail you get, and it's all laid out there for you in the alert. And here's a summary of what happened. If we'd sold 3 contracts, it's a $90 paycheck. It was trading at $41.80 on January 21st. We sold the week 4 $40 puts. We collected $30 a contract, meaning 30-cent price in the premium. $4,000 capital was required for each contract, $12,000 in total if you did 3 contracts. It closed at $45.78 on January 23rd. The trade expired. We kept the $30 per contract, or $90 total, in just 2.5 days. That would be a return of $4,500 over the course of a year on $12,000 in capital that you would have had to put up. So you're looking at 35% or more annualized return. And if you saw the track record, the average transaction last year was 29.9. So these bunt singles add up. This focus on the week or the month really, really, really does add up. And here's one Starbucks because we mentioned it. Here's a real detailed and granular look at the inside of the alert. I think you can read this. There's the trade. What's the trade? What is your action? Here's the action. When does the put expire? This is the date. What should you get? And I give a range. You have to have a range because you're not necessarily going to get the price when this is distributed. What's the current stock price? So you have a sense, if you haven't been to your email in a couple of hours, why has the price of the option moved? It may be because the stock price has moved. What's the capital requirement? Remember, you're not spending this capital. You're leaving it in your account when you're selling a put. What's the target price to close? Almost always it's 0. Once in a while I'll specify a target price to close for a monthly put, but mostly it's 0. When the service started in 2010, volatility was so much higher, there was almost always a target price to close, and now we just go for 0. So the absolute potential rate of return here was 2%. And if you did this 12 times, that's a typo. If you did this 12 times a year, it would be 24%. So it shows that when we have editors now, when I do my own editing, this is what happens. So you can see the level of detail. It's very compact. It's very complete. When I do live trading sessions with my coaching people, we do the equivalent of this, and they're all doing their orders in 30 seconds. So you know that this is a very, very, very simple thing to execute. And here, because it was a monthly and it went up so quickly, we closed it out. The rate of return went up because it was a shorter period of time. And you can see the detail again is here. This is what you, with the cash in hand, what's the action? How do I close? What price? What's the profit? What's your absolute rate of return? And what's your annualized return?
Michael, can you stay on that screen for just 1 second?
Sure.
For Elian, the alerts do tell the strike price. Michael, can you just walk through where the strike price is so they can see that?
Well, the strike price was up here. So the strike price was $87. It was the $87.50 put. So the people who got this would have already been in, the people who responded to the second alert would have already been in it, and the strike price is in the title. So on the closing alerts, we don't feel compelled to go back to the strike price. You're not selling anything. You're buying back something you've already sold. You're already in the position, but the strike price is specified in the headline. So when people are getting their emails, they'll know that am I in this trade? Did that answer the question?
It did. Thank you.
You're welcome. So we'll wrap up. I'll give this back to John because he's great at answering a whole bunch of specific questions, but I'm here to answer questions as well. I want to thank you for your time. And all I can say to wrap up is let's get your questions in, and it may be questions that serve everybody.
Excellent. Thanks, Michael. And I will take a couple of the simple questions right off the bat that relate to the trial and the subscription. And then I have already a backlog of our typical usual suspect questions, Michael, which I will feed to you here in just a moment.
Sure.
And you can already guess what most of them are.
Yes.
Again, it's a 60-day test drive for $79. And in that time, you're going to get, again, weekly trade recommendations and monthly trade recommendations from Michael. You'll have complete access to the entire 5-module Options Income Blueprint training course. And again, that teaches you all of Michael's tactics and all of his strategies. You'll have in addition, you'll also have some of the bonus videos, some of the bonus reports. And then typically once every month, Michael also holds live strategy sessions with all of his members so that they can walk through recent trades, talk about what's happening in the market, talk about what kinds of events are affecting the market, where the opportunities lie, and then obviously do a rather robust question and answer sessions to help everybody. Now, the reason we set this up as a 60-day trial is so that you can make sure that it's right for you. Selling options is not right for everyone. It's up to you to make that decision. Obviously, we're going to tell you it's right for you, but that's a little bit in jest. But the reality is, only you can make the decision about whether you want to take control of your portfolio and the income that you are generating from that portfolio. That's it. It's up to you. This is a strategy that has been working for over 4 years. Michael began teaching selling weekly options and selling monthly options back in 2011, and that was really at the advent of when weekly options became accessible to the retail investor or retail trader. And he's been doing this program for over 4 years. And I have a really great question, which I'm going to pass along to him in just a minute. But once the trial is over, once that 60 days elapses, you can either continue on for $79 a month, or at that time we'll give you an opportunity to upgrade to an annual membership, if you will, for a discounted price, typically a 33% discount off what 12 months at $79 would be. So, and I'll let you folks in on a little secret, because one of the things that we typically do with that annual upgrade after you've been through the trial is we give you your 2 months back. In other words, you can upgrade to an annual, and we give you 2 months free when you take that upgrade. But that is going to be going away at the end of May. So this is the good time to get in, because the opportunity now for you to test drive this over the next 60 days, make sure that it's right for you, make sure that this fits your investing or trading style, make sure that you can prove to yourself that you can generate the income that you need to generate from your portfolio. And over those 60 days, by the time we get to Memorial and we eliminate that 2-month bonus, you'll be one of the last people to have access to that 2-month bonus. So again, it's our way of saying sort of thank you for taking the test drive, and thank you for committing to this for the long term for yourself. But that's why we've always given the 2 months back to our subscribers. But again, that's going to be going away at the end of May. We have not made that public knowledge, so you were the first 120 some odd people to hear that, and so make sure you take advantage of all of this today. So one of the questions though that I wanted to start out with has been asked by a number of people. And it relates, Michael, to whether or not these are naked puts.
My favorite question. John and I have known each other a while. I used to run a short service. I wrote a book called Sell Short. There's no such thing as a naked put. Unless you're at Halloween and you dress up as a put and you're not wearing any clothes. A put is collateralized. It's collateralized by cash or margin, and obviously not margin in an IRA. It would be collateralized by cash. Some hedge funds can sell naked puts, maybe, perhaps, and you can do all sorts of things, but they're not naked. They're what is known as cash-supported or collateralized puts. So it's not a naked put. I still think brokers use that term because they don't want to deal with people who are selling puts, the traditional old-fashioned brokers. But none of the online brokers really use those terms very frequently. So it's a misnomer because naked is scary. They're not naked. They're supported by collateral.
All right, and again, Val, the price after the trial would be $79 per month, every month. thereafter. You can stay as a member as long as you like. You can upgrade to the annual membership if you should choose. Val also had another question, as did several other people, Michael, regarding spreads.
Oh, these are not softball questions. We didn't put with seeds in the audience, but we've been, I answer these questions of members all the time. In this service, I don't use spreads. There's a reason. For those of you who are not familiar, a spread is where you're doing two positions at once, and the theory behind a spread, there are two reasons for it. One is to limit your potential losses on a transaction. You're limiting your profits, but you're limiting your losses. But it's transaction focused. It's not focused on the long-term future of a company. It's not focused on anything other than the transaction. The other thing is spreads leverage your capital. You get to stretch your capital a lot more when you're using a spread. I don't do them because A, I feel they're limiting profits, and B, you can lose money on a spread. In my service, the winning record is a matter of fact as opposed to an opinion. And what we do is, in fact, I said today that there are a couple of positions expiring worthless. One of them is a rolled position, meaning we sold Tesoro puts. The puts, the stock moved the wrong way. We bought back the put and we sold another one, increasing cash as we did so, of course, and the stock rebounded and it's going to expire worthless. We use rolling. Rolling is a standard industry term. It's on my broker screen at Options Express. It means you're rolling from 1 week to another week, or 1 week to a month, or 1 month to another month. It's a far more profitable way of managing, generating consistent income than a spread. And in some spreads, you can't roll them. You just have to lose capital, and to me, that's death. I will do anything to avoid a capital loss, and so those are the reasons. In my coaching services, I do simple calendar spreads, but I'm doing long-term leap call spreads because I believe in the company and the stock. And as long as you believe in the company and the stock, you can be very aggressive selling a put. And when you're aggressive selling a put and you get a temporary bump in the road, you simply roll the position until it's profitable.
Michael, if you would, there have been a number of questions about what if a stock price moves against you, what if you get put the stock. Can you talk a little bit at length about some experiences you've had with the membership base in those regards? Yeah,
and we'll get this out of the way. I mean, because some of the numbers here, frankly, are hard to accept when you hear these winning numbers and whatever. We'll talk about rolling, then we'll talk about accepting shares. Rolling is very standard. Last year we had 85 positions that opened and closed in the same year. So I think there were 93 positions total. A little bit more than the previous year. I think we rolled 17 positions, and I think maybe 6 or 7 of those were weekly. Almost all of them closed within 2 weeks, and one didn't. And that was one where there was a warning put in the alert that we're putting on this put position before an earnings announcement. I don't do earnings announcements in this service very often. It's usually about 1 a quarter. And what happens, and I'm not using this term lightly, we call them clunkers. About 1 position a year really goes south on us. And out of 80, well, last year was 93. Last year was CRE. It was a pre-earnings announcement trade. And the stock sold off and continued to sell off, and we're now in a position where I recommended accepting shares, and so the original position was a $45 put. The stock ended up going down to $29. We've gotten our cost basis to $41.87. That's our cost basis, not $45, and the stock's at $38 and change today. The sale of one more call and we'll be at break even. That's the strategy for protecting capital. It wouldn't work if this happens frequently, but it literally is 1 to 2 stocks a year. 2 years ago it was Whole Foods Market. Again, it was an earnings announcement. Last year it was CRE, and this year it's U.S. Steel. Well, that started in last year. These are all U.S. Steel is because of Chinese dumping of steel, and the stock. I pushed the trade. We traded from 22 to 45, and it's reverse direction. But the bottom line is that does happen. It's extremely rare that we get put in a position where we accept shares. We just don't do it. We roll. And if you put shares, I provide guidance. I don't necessarily do it in the service. I do it in email. Sometimes someone will be put shares even though they miss the alert. I more often than not, when I'll recommend close the Tesoro position, someone doesn't do it, and I forgot about it, and I had one contract, I got put the shares. What do I do? I'll work with them on email to tell them what kind of strike prices to look at on their calls. We in the service. Meaning once every 2 or 3 years, I will willingly accept being put shares because I just know the stock is going to bounce back and we're going to sell calls and make a lot of money. It's not, you don't do it to break even. So the 3 things that can happen is you can roll, You can voluntarily be put shares. You can be put shares accidentally. And we voluntarily accept shares about once a year, maybe twice 2-3 years ago. But that's about it. Everything else is rolled, and the rolls are very, very successful.
And next question here from Elian. It is honest question. If you discover the strategy, why are you sharing it, selling the strategy, and not just scale it and live happily ever after making more money than you need?
Well, that's a good question, because if I had enough capital, you wouldn't be hearing me right now. Trust me. It's a question I appreciate, and I'm gonna answer it for myself, and I'm gonna answer it by way of analogy of a public figure that you know. I like teaching. In addition to this service, I have 2 advanced coaching services. I did the seminars in Florida. It is something I like to do. If I was worth $100 million, I might still be doing it. I might be doing it in a luxury hotel while the members are staying at a Hampton Inn, but no, I like doing this. And I'm at a stage in my life, I'm in my 50s, that I can damn well do what I please in terms of, living the way I want to live, and part of the thing I want to do is to do this. And the happily ever after part may be 10 years from now or 20 years from now. It's certainly not now, because the thought of trading alone in a vacuum is extremely unappealing to me. I like being with people. I'm a chatty guy, and I'm chatty by email. I have a lot of fun with my members. A lot of us know each other. Florida was a blast. I met people I'd been emailing for years. We had a great time together. And it's part of the enjoyment of a job, of a profession, excuse me. Now, the analogy I'm going to make is there's a person I used to work with, John Najarian. I never met Pete, but I knew John, and John and I were at the same publishing house, and he's gone on to CNBC and Fast Money and all that stuff. He's a wonderful man, and his business is just flourishing, and he has no need to be on CNBC and spend all the time in front of the camera and do all his stuff. He loves doing it. He just absolutely loves doing it. So there's someone and is making pounds and pounds of money in his trading shop. He just likes doing it too. And it's sort of an avocation of what we like to do. The happily ever after piece, though, I'm going to share a story. In Florida, and I won't mention his name, one of my coaching students who started with Options Income Blueprint, when we introduced the coaching service, he joined. He wrote me an email once, because we were doing surveys how many positions people have open. He had said I had 175. And I wrote him back going, I want to meet you one day. It turns out he's a retired industrial process engineer, a brilliant one. So this comes naturally to him, and he said he's shrinking positions. But here's why I do this. Here's the answer to your question. He goes, I wanted to thank you in person. I said, for what? I mean, I'm getting your money. You're paying me. He goes, I have a house. I live in a state, and I don't want to share any information. He goes, well, my grandchildren live in another state. And I was able to buy a home near where they live with the amount of money I've made with your service for the last 2.5 years. Now, I don't sound like I'm a raging capitalist. I'm no Boy Scout. But that comment alone makes it worth doing this for another 5 years. I just like doing it.
There you go, sir. And Elian, an honest answer. And quite frankly, people need help. I can't stress that enough. As we shared at the top, you can do your own research to validate this. Bond yields are 50% lower than they were before the financial collapse. CD interest rates, savings account interest rates, you might as well put your money in the mattress. Dividend yield stocks are now higher risk than non-dividend yield stocks. So the problem that income investors have, or people who are trying to produce income from their portfolio, is where do you get it? So the other part of the honest answer to your question is the opportunity to sell this as a program that teaches you how to do this for yourself. Now, yes, Michael is giving you trading alerts. Yes, Michael is giving you trade recommendations. But the purpose of putting this together with the education program is to teach you how to do it yourself. And you won't get it in the first 30 or 60 days necessarily. It may take you a few months to do this. But we've had numbers of members over the last few years who have eventually said, Michael, I don't need you anymore. They've put their own big boy trading pants on, and they've gone off on their own direction. So at some point you have to find a mentor. Everyone in the marketplace has a mentor in some capacity. Everyone who's been on Wall Street, everyone who's made it to a CEO office has had a mentor, someone who has shown them the way, taught them the path, and then helped them navigate that path. And that's how you should think of Michael here. He can teach you how to do this for yourself. You'll be able to learn how to do it yourself. One of the biggest things, and I think Michael shortchanges himself on this, especially when he tries to talk about it, he doesn't really. I think he needs to talk more about this. This is just a suggestion for you, Michael, and that is his ability to see trends and then identify companies that can benefit from those trends, and then construct a trade that you can use to create income from that trend and that company.
And
it's something he's very, very good at.
If I may, to expand on that, since you're telling me I'm being too self-effacing, and we're having fun, is I do, and it's something that's not explained in a brief period of time like this, but I do 7 to 10 trends with my own names. One of them is iWorld, the other is the New American Kitchen. The third was Frack Baby Frack, which is different than what you might think. It's not just fracking. And there's a necessary component to this. Wall Street, and I'm not criticizing them, I like to have fun with them, they're straitjacketed. They have to look at stocks in traditional sectors that their clients, their investment banking clients, their pension funds, they want what's going on in retail. And let me give you an example of what John said, which one of the things you would benefit from the service. I alluded to the millennial and boomer overlap. And people cannot figure out why wages are going up, gasoline prices have fallen radically, but retail spending is down. Is it going into savings? No. It's going into sushi and travel. It's going into food and travel. And I think, and I'm not kidding, I think because there's one Whole Foods Market in Lower Manhattan and the Starbucks are tiny in Manhattan, people sometimes get these blinders on as analysts about what's going on in the real world. And I spend a lot of time. I go to a shopping mall at least once a week, and I haven't been arrested yet. I just watch people. You know, you have to, and you ask and you chat people up. You have to do things like this in order to be different and better than Wall Street, because individual investors doing Wall Street advice lose money because they're getting the advice after everybody else on Wall Street's already seen it. So you have to stay ahead of it. And for example, with Apple Pay and the Apple iWatch, this is the first at-bat in the first inning of a baseball game. iWatch is the ultimate personal device, which is going to be turned into a personal physical monitoring system, both for health and for exercise. And it's the first inning, first at-bat. And iPay is going to be 200 times more important than iTunes and is just beginning. And the whole design is to sell hardware. So as long as Apple is not trying to make a profit on iPay or the services on the iWatch, they will always be better and more competitive than their competition that usually has to make money on it. And so why am I mentioning this? The trend is disintermediation. It's cutting out the middleman, and Apple is now a great disintermediator of credit card processing services. It's going to be a great disintermediator of certain health services, and you just heard the rumors about Apple Television. They're going to be a disintermediator cutting out the middleman called your cable channel. And because they're only trying to break even on services to sell hardware, they will be more competitive and a lower cost product than any of their competition. Disintermediation is a theme. So when that theme intersects with something like food, the stock is Grubhub, Grub. They have 400,000 menus, I think, and you go on there and you order your food, and the local restaurant is responsible for delivering it. Well, they just announced they're going to start their own delivery services in trial markets. I'd be willing to bet within 12 months they hook up with Uber in order to do deliveries. So this is not something Wall Street's watching. They have Grubhub in the takeout fast casual category, but they're not. They're a disintermediator and a software company. So as long as you look at things differently than Wall Street, and the guys on Wall Street, gals are very smart, they're constrained. I'm not. And you, as an individual investor, you have to stay ahead of them, because when you get their research, they've already used it and made their trade.
Thanks, Michael. And folks, we'll stick around and answer as many questions as you have. We want to make sure that this is right for you. So I am still sort of way back at the beginning of some of the questions. So if you've entered a question recently and I haven't answered it yet, please be patient. I will get to it. Right now I'm all the way back down on Linda's question, which was, can you let us know the price range of stocks on which you sell options so we know how much cash we need to have on hand? So if, in two parts, the price ranges on stocks you're typically working with, and also typical account sizes. Sure. And if you would,
it's a good question.
That question for me.
It's a very good question, and it's a big range. 2 weeks ago, we did something I've only done it twice in the history of the service. It was Bank of America. Not that we've only done Bank of America twice. I actually recommended an in-the-money put, meaning the stock was at $15.97, and I recommended a $16 put, and the put expired worthless. So it's as low cost as Bank of America, which is a $16 stock, and the most expensive would be probably Gilead Sciences, which is about 100, or Apple, which is about 125. And they're Apple minis, but they don't trade very well. I don't like the way they trade. And I'm aware of this, meaning even though I manage my own money and I'm aware that people have large accounts, this is a publishing membership service. So there's always a mix of prices. I never get stuck. I wouldn't do like Tesoro, Skyworks, Apple, and Gilead 4 trades in a row because they're all very large price stocks. So you have stocks in the 20s like Corning, and you have stocks in the 30s like General Motors and Cree, and I could go through a whole list. So there is quite a range. In terms of account size, you really shouldn't think about this unless you have $10,000 that you're going to put to it. And even then, please be aware you're going to be constrained. You're not going to be able to take advantage of the most opportunities, meaning if you do a monthly, you may just have to wait for it to expire for 3 or 4 weeks. If you do weeklies, you may only be able to sell 1 or 2 contracts. So it's not, 10,000 is not optimal. It's sort of the bare minimum. But there will be stocks to trade. You don't have to worry about that. There's a complete range. I traded 39 or 41 or something like that different names last year. So it's a fairly large universe of names that we trade in the service.
And one other question, or the next question rather here. I lost the name on this one. I'm sorry. Hang on a second here.
Hello?
I lost the name on that one. Sorry. The question was, is there an advantage to selling weeklies over monthly in terms of the premium, one or the other?
Well, theoretically, if you traded weeklies every single week, you would make more money. Depending on the stock, you would. It depends upon the size. If you were only selling 1 contract, the answer is no because of commissions. But if you're selling, either a high-price stock like a Gilead, you're doing 1 contract or 2 contracts a week. Let's say 1 contract. It's a $100 stock, and you're selling a $100 put. You're going to make more money if you did it 50 weeks in a row than you would if you sold monthlies. That's almost true across the board. If you sell monthlies, you get a larger amount of cash up front, and should the monthly move, like Southwest Airlines did this week, you can buy it back and still enjoy a return. It was very interesting. There were 2. I try to be responsive, and I added more monthlies this year, and I added buy rights, meaning you buy the shares and sell a call, and you're actually hoping to be called out. I hadn't done buy rights in a couple of years because when I tracked, no one was doing them. I mean, I would put the trade on, and you'd take a look at volume, and nothing was happening. The buy rights and monthlies bought back early this year have outperformed the regular weeklies and have outperformed the regular monthlies that we let expire. I'm not exactly sure why. I wish I could tell you, but they really have performed exceptionally well. So I'm putting actually more monthlies on. I just put an April on, which I haven't done in ages. I put an April on in March. We were still in the March cycle, and I put the Southwest Airlines on as part of my oil trade. And so the narrow answer is 50 weeklies are much better than 12 monthlies if you don't buy the monthlies back. But please be aware, it's nice to have a mix. Assuming you have more than 1 or 2 positions, you do not want all your positions expiring on the same day because something could happen. John Boehner could, his suntan would fall off, and there'd be a riot on Capitol Hill, and the market would go down 500 points. That's a bad joke, but I live in Washington, so everything's political jokes. So you don't want something happening, the day before you have all your positions expiring. So you need a mix of monthlies and weeklies if you're managing a portfolio that has several option positions.
Thanks, Michael. And let's see here. We just have a couple of more, it looks like. Harry says, I'm making 0.5 to 1% per week on covered calls. Is this better?
You would see this if you join the service and you take the training program. If you're a long-term investor on a company and a stock and you hold it for a while, you will always make more money over the long haul selling covered calls because you will also you will enjoy some of the appreciation of the underlying shares. So in my own portfolio, I mostly do calls. I do some puts. You can see from what I'm doing for a living here. We have found from surveys that 75% of our members do both, or 80% of our members do both. 75 or 70-something prefer recommendations that are puts, but there's been a significant increase. We do surveys like every 6 months, I think. There's been a significant increase in interest in covered calls. So I've introduced 3 covered call positions this year, and I'm going to be doing more, probably 1 to 2 a month. And they're working very, very, very well. Now, the covered call positions I put on here are mostly designed to be called out. I don't want to have to track a zillion stocks, and people don't. They want something shorter term. But the straight, narrow, short answer for you is if you like the companies and stocks and you trade them frequently, a covered call position where you're able to manage tightly and get some. My target is you enjoy half to 3/4 of the appreciation of the shares while you're still collecting the premiums. They will always outperform puts on the same stock.
Thanks, Michael. And Elian asks, in the alert, actually, we'll combine 2 of the questions here. Do you indicate whether to sell the monthly or the weekly, and how many alerts are you sending out on average per week?
The alerts are specific for a position, not a company. So the alert would be for a specific seller. Well, let's go up here. I'll show you. Here we go. They're very simple. This was to sell a February monthly week 387.50 put, as specific as you could get, including the range of what you would accept as an appropriate price. So let's say you missed the alert, and we're adding SMS sometime this next quarter. If you miss the alert, then you wouldn't make the trade if you couldn't get $1.50. I don't think it would be worth it to put your capital up. So they're very, very, very specific. And what was it? There was 2 parts to the question, John.
Yes, on average, how many alerts are you sending out per week?
I would say I've increased frequency. We did 93 new positions last year, which nets out to about 2 new positions a week. I'm probably averaging 2.5 now. It just depends on market conditions and the conditions of my companies and stocks that are in my bullpen. So what I did, for example, the last 2 or 3 weeks, because of what was going on with the Fed and actually what was going on with oil, I kept the frequency up, but I reduced the target transaction. I try to target an annualized rate of return of 35% or more. And because of what was going on in the market, I wanted some more conservative put positions. So we were targeting between 25 and up, not 35 and up. A couple slam dunks. I mean, there are companies like Gilead. It's like printing money, you know. And I don't do Gilead trades as often as I used to because so many members do it on their own. But you know, Gilead at 100, it's like printing money in your own basement. And you know, sometimes it's too low for a recommended transaction, but once it would go above 25% annualized basis, I would put it on. So I'm giving you a long answer, but the frequency's been increasing. Now it's going to slow down in the next couple of weeks. I reconfigure the bullpen every quarter, and what I mean slow down is this is the end of the cycle. So 4 positions close this week, which is a little unusual. You will see new positions coming on monthlies and weeklies with increasing frequency. There aren't any open positions. And to your point, when you sign up, if you sign up, the open positions are not ones you should get into. You should only get into a position when an alert comes out.
All right. Thanks, Michael. And do you trade your own alerts? In other words,
do I eat my own dog food? Absolutely. I eat my own dog food. That's an expression from the computer business, the software business, which I was once in. I do it in a different way. As I said, because of the size of my portfolio and the position I am in my life, I traded mostly puts until my kids graduated, and now I'm in a reinvestment mode in my portfolio. So it's a portfolio is much more concentrated in equities that I believe in selling calls, and the money's reinvested. And I day trade a lot. I don't day trade. I day trade calls, which is something we do in the coaching services, where I follow, because of what I do for a living, I'm at my desk and I know these stocks, I'll just know when there's an anomaly and I'll sell a Gilead call in the morning and buy it back in the afternoon, you know, and make a chunk of change. So the dog food part is the company and the stock. You saw from the presentation here that are the names that I was suggesting you take a look at, and if you take a look at the names I've frequently traded in the first quarter in the service, I own most, if not all of them. But that's not a put, that's a call. But to me, it's the same position. Once in a while, not once in a while, probably half the time, I'll put on the exact put position. I don't put any positions on, by the way, until I receive the alert. I'm on the mailing list for the alerts, and for obvious ethical reasons, I only put the position on after I get my alert. And if I write about a company that I own the shares, I disclose. There's always a disclosure, and the disclosures are on the website as well.
All right, we'll do. I'll do a last wrap-up call, Michael. If we could fast forward to the last slide. Again, the optionsincomblueprint.com/go. The link is also in the chat box and/or the admin notice box, and there's also a pop-in box to the right of your screen with the along with the chat box. Any of those buttons or links will get you into reserving your trial. And we'll see. Give about 30 seconds here to see if there are any additional questions, but I think we've covered pretty much all of them. Again, you're doing this for yourself, folks, so we're looking forward to helping you. And with no further questions here, Michael, I'd like to say thank you again for another great webinar.
Hey, you're very welcome. Thank you all for coming.
And we'll see everybody on our next event-driven webinar, whenever that happens to be. Thanks for everyone here at Traders Reserve and the Options Income Blueprint. This is John Hutchinson. And for Michael Schulman, I want to say thank you for your time this afternoon, and we look forward to working with you.